All right, everybody. Like yesterday, I wasn't able to get the market outlook out before I had to leave for the evening. I was gone out of town the last 2 nights, and so again, this Thanksgiving morning, making a market outlook for yesterday. I hope you all having a great Thanksgiving holiday today, and that you all have a great holiday weekend. Just a reminder that our Black Friday sale for our premium subscription is live now. If you go to marketscholars.com, there's a bar across the top. You get a 20% discount on our premium. That's the biggest that we ever give. It's always on Black Fridays. Works out to be in about $75 a month, and you get access to all 10 of our trading rooms that we have, all 8 of our trading rooms, and then our 2 Q&A sessions, among all the other premium tools and services that we provide for our clients. And you can kind of see, if you follow Brandon on Twitter, you follow myself on Twitter, you can kind of see some of the success that a lot of our clients have been having with what they've been getting out of Brandon's classes and my classes over the past, 7 years now, going on 7-8 years. We've been doing this for a long time and plan on doing it for a lot longer. And so that's live, and you can also, if you follow me on Twitter and you go to the pinned tweet, today's market outlook tweet, you can see in a reply information as well, and a link to get to the information for our premium subscription. So today's video, again, we break down what's going on. We'll take a look at our trade idea in a sector that has been, like, this particular stock has been so beaten up all year, but it's finally showing some green shoots in the fall, no less. Green shoots. So we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, November the 27th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Remember, we also have our premium subscription right now on this biggest sale of the year, biggest discount of the year. So check that out. It ends up, like I said before, working out to about $75 a month. Also, follow us on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old trades that we've done in other Market Outlook videos to see whether we should stay in them or get out of them. We talk about how to manage them. We also put on today's trade already before the market closed here. Come down to the bottom, click this heart. It opens up this tab. And hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Scroll down and click the like button on today's Market Outlook. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do right now while you're watching with 1 or 2 really easy clicks. Let's get started taking a look at the market forecast indicator on the S&P 500 like we always do. Obviously, we broke the streak, 7-day up streak. We broke the streak yesterday. The intermediate line did maintain its upward climb, right? It's in the upper reversal zone. It's above market sentiment. It's almost to that 90th percentile mark, which again signifies a nice strong trend. We have not eclipsed that 2.5% mark above the 30-day moving average. We actually dropped. Now we're less than 2, but still that's okay. That's pretty decently strong. The near-term line crossed below, but again, that doesn't matter when the crossover occurs in the upper reversal zone, right? It matters more when it's down here. Like, again, that's a bullish crossover right there when it occurs below, like between the reversal zones. It is down. The momentum line did finish with oversold. So technically, by definition, this is an oversold, oversold confirmation signal, an intermediate confirmation signal, a bullish intermediate confirmation signal. The idea is the momentum line, when it gets oversold, as you can see, doesn't stay down here for very long. The problem is when it gets down there and the near-term line is still bullish, it's hard to get a bounce, right? That's not very much of even a near-term reset. And so most likely it probably signals something like we saw here, where it will stay down, and then eventually comes down here later, brings that near-term line down eventually, right? So that probably means after Thanksgiving into next week is probably will end up with that near-term decline. The near-term line will probably come in towards bearish territory, if not below the 50th percentile. Then we should probably get, considering this is a bullish high point, you would expect we'll get a bullish low to follow it. Now, that hasn't been the case. We've been getting bearish low, bullish high, bearish low, bullish high. But until we see the bearish low, or signs that we would, that the signs to anticipate a bearish low, Like again, the near trend line dropping below 60, the momentum line below the near trend line, the momentum line below the 20th percentile, ideally, near the extreme lows down here. Those are all signs that would suggest that we would get a bearish near term low. So unless we see that, you would anticipate that we'll get a bullish low coming off of this bullish high point, especially considering the intermediate lines in the upper reversal zone, right? If the intermediate line wasn't, if it was still kind of lower, then that might be a different story. But considering, because you'd be crossing through it on the way down and, a difference. But considering it's in the reversal zone still, you would anticipate, again, barring an extreme low on the momentum line and the near-term line dropping below 60, like close to like maybe below 40 on that first day below 60, that will get a bullish near-term low. We probably won't flirt. Like if it gets down to an extreme low, like again, the last 2 times we did get an extreme low, and we were actually at the 5th percentile. We were like down right here at the lows of the day yesterday. So if we were to, the last 2 times we got to extreme lows and the near-term line fell into the reversal zone, we got bull tags, right? So we'll see, if that ends up being the case. It's unlikely. I don't think that will necessarily be the case. But we'll keep our eyes on that. One down day today doesn't mean that world is definitely does not mean the world is over, for sure. Let's take a look at the NASDAQ 100. And you can see this is a little different story for the NASDAQ. We actually are close to another bull tag. The intermediate line's not above the 80th percentile, nor is it above market sentiment. And your near-term line has crossed below the intermediate line between the reversal zones. So again, your momentum line's not too bad. Remember, this is day 1 of the near-term line crossing below 60. Your momentum line is below, but it's not extremely low, nor is it even below 20 at all. So, as bad as it looks, there's a good chance we can, that we'll just kind of bounce off of this. So, it could be worse, right? It could have been a lot worse. Had we finished near the lows, it would have been a lot worse. But fortunately, we didn't, right? There was enough bullish sentiment still in the markets that we closed off of the lows there. Looking at the Dow Jones, which has been so bullish relative to the S&P and the NASDAQ, it kind of looks very similar to the S&P, right? But the difference, again, your momentum line's not below 20. It's down in bearish territory, but it's nowhere near oversold. And your near-term line has dropped out of the reversal zone, but again, your intermediate line's above the 90th percentile. So there's no threat here of any impending doom. And the same thing with the Russell 2000. You did get a crossover below the reversal zones, but at least the intermediate line has made its way above 80. We did drop to near extreme lows yesterday, but your near-term line stayed above 60. Now we're down there again, and the near-term line is below 60. So, this is the kind of pattern that would suggest that that we will get a bearish near-term low point. So that's something to keep an eye on for the Russell 2000. If it starts to, considering that it lagged, and usually whenever it makes these kind of lagging moves, that's kind of when everything peaks. When it makes its own catch-up trade, so to speak. We talked about that quite extensively in our technical analysis class yesterday before the holiday. Let's take a look at the weekly market forecast now. Let's go let's wait for that until Friday. Let's take a look at the regular weekly chart. I'll do a market outlook on Friday, assuming if we get anything like any kind of volatility. I probably still will do something a Friday morning. Remember, the market's open a half day, so I probably still will end up doing something on Friday since I'll be around. Good strong bullish candle this week. Again, a higher high, a higher Hakinyashi close. The PPO is rising. It's at high levels and above the 90th percentile, hence the green dot. You are still in convergence mode here. So, we are, kind of getting these, brief jumps above the moving average, and that's where we're at right now. Again, don't expect that to last too long, which means we'll probably get a transition candle next week or the week after that. So we're not going to get like a big candle like this. And if we do, then we are definitely going parabolic into the end of a run. Usually we just kind of grind down into our intermediate decline. If you look at the 3 green arrow charts, we do have 3 green arrows except for the NASDAQ. The NASDAQ was getting close to one But now we're back to two reds because the stochastics has turned back down. So all the other stochastics are actually in the reversal zones. The stochastics on the NASDAQ is not. So the NASDAQ is definitely showing some weaker relative strength, which is not good for the markets because that's our leader, right? That's the general, right? We kind of need the general to lead the way higher. Everything else is looking really good, well above moving averages. The NASDAQ looks like it's close to a three red arrow signal. And so we'll keep our eyes on that one going into next week. Here's the two-line version of that chart, well above moving averages. But again, the MACD is, typically when you're coming off of a low, you get the biggest surge in the momentum because you have to, right, to get that escape velocity off of the low point and start a new trend higher. So you get your biggest surge in momentum off the low. You saw that here as well. The MACD itself peaks on that first initial run. That's typical. And then you start to get smaller histograms and smaller peaks on the MACD before we finally roll over. Absent this, right, this was a very anomalous type move because of the presidential election, a big surge in momentum coming off of the election there. But the reality is we are still in this convergence mode where you're getting small histograms, and we're back to it here, and then smaller peaks, right, smaller peaks on the actual MACD itself. And we're actually setting ourselves up for a divergence pattern here with lower highs on the stochastic indicator and slightly higher highs here on the index itself. Yeah, in fact, you see that across all these oscillators. The DMI has lower highs on the positive indicator, slightly higher highs, right? We're back below 30. The ADX is still below 20. Usually the ADX, this was actually the topic of our class, is kind of watching to see how these intermediate rallies end on the DMI and the ADX indicator. This is very typical, right? Either you go parabolic or on most intermediate runs where you don't have a parabolic move, you end with with the intermediate line, or the ADX line, getting almost a 30. Very typical. This is very typical of an ending of an intermediate run. Going into the election, it kind of looked like we were. But we didn't quite do that, and then obviously the rebound there, and you kind of see what happens. So it's kind of interesting to see, like, we're going to end this intermediate run without the ADX even getting much less, not getting above 25, but getting above 20. So a very interesting pattern there on the DMI. Like I said, we spent quite a bit of time in our class breaking that down, looking at past precedent. For how that indicator works. The RSI is still above 60. The CCI is still easily above 0. So those are strong levels. If you look at the, let's see here, the Ichimoku cloud, you can see, again, we have intermediate strength, or we don't have intermediate strength trend yet. It's still very weak, right? We got to cross these dotted lines to really kind of solidify the trend and hopefully get it up to mature levels. But we have strong rate of change. We're easily above the cloud. The cloud's still green, though it is shrinking. The cloud is still green, so we're still okay. IWM is, looking really positive. It was kind of lagging previously, but it does have a mature trend, right? We saw this before, and then that's kind of when the S&P peaked there. So we'll see if that ends up happening again here, right? We're kind of getting a very similar move to what we saw in July happening here in November. And then finally looking at the Bollinger Band, the bandwidth remains at elevated levels about midway through the last 150-day range. We're not in the upper quartile of the bandwidth, and we're not above the upper Keltner channel. So that even though the momentum is positive and the trend is bullish, it's still weak, right? It's still a weak trend. And then let's look at the intraday chart. Yesterday we kind of got a higher high and a higher close, and we closed at the highs of the day yesterday, or near them. Today we did not. We closed, we got a lower high and a lower low, and slightly, on both cases. We actually did close above yesterday's low, right around the point of control. There's a lot of support up here. And then you can see we're getting very top heavy, and as I mentioned before, this range is about to shrink in a very big way, right? Unless we get a significant new high point here in the next 3 days. This range is going to shrink up. The low point's going to get up to here and move up 16 points. And we're going to get a significant drop in this, which, can be a pretty negative. I mean, obviously opens the door for a break below the 4-week low point a lot easier than it is right now. Right now, there's no concern for a break for a 4-week low point. But if the 4-week low is, where the current midpoint is right now, then there would be a pretty significant concern, especially if we close Friday below last week's high point, right? Because we have a higher high, we have a much higher low point. So we need to close above last week's high to really kind of solidify the bullish trend that we have right now. Looking at the volume, not surprising to see volume and trading ranges down today. Let's look at it here. Or for yesterday, for a pre-Thanksgiving, like well below the average in the volume. So obviously what really matters here from a trending standpoint is that we are below the 1% mark on the normalized ATR. And we're still above the 0.8% mark, which is the extremes. So we're kind of in a sweet spot right now, and that's great from a trend. Because again, when you're bullish, that's why it's so hard to buy calls. Is when you're bullish, it just grinds, and that's hard to make money on leverage directional trades when it's just grinding to the upside. But for long-term portfolios, obviously, we're okay with that. We love the grind. For our long-term portfolios. A tortoise always wins the race, right? So we'll take that there. If you look at volatility, volatility does remain semi-elevated. Not the VIX. The VIX is low, like below 15, below 85%. I mean, this is pretty low. It's below its 200-day moving average. But that VVIX just cannot get below 90%. It's just barely dipping its toe underneath it and can't really drop down here to like the 80s, which is where we kind of need it to get to. Needed to get to here. Let's go VVIX on this. We need to get down into here, right? This is below 90% is the sweet spot, and we just keep flirting with it, and we can't get below and stay below. In fact, yesterday we spent quite a bit of time above, up to 94 yesterday. So, that's not what we want to see. So the VVIX, and really, when you look at the skew, let's pull up the skew here. The skew has been at extreme marks. Let's look at the skew again right here. So 2 days now above 165. Like there was only, like if you go back in the history of the skew, in 2021 we had a single day above 165, and we just had such a strong move. We look at all these days that we've had in the past, 6 months or so, even less than that actually. Since not so much here. There was like one right there. That's 2021. Here, let's do 6 months is what I wanted, not 6 years. So there's that one day in 2021, and then here you can see we've had 1, 2, 3, 4, and then 5, and then yesterday 6, and then the day before 6, and then yesterday 7 days. Of the skew being above 165, and the average is now climbed back above 150. Remember, 150 is the extreme level for skew. So the demand for deep out of the money puts is at extreme levels right now. There's a lot of demand. Why would people want to buy out of the money puts? Why is the VVIX not able to really drop and stay relatively elevated itself? That's the issue, right? That the markets have. So the skew did drop post election, and that's to be expected because that the VVIX dropped, the skew dropped, that anticipated event came and went, and there's been no issues, so everything should be fine. But the problem is it's not. Like we should be dropping down into the a lot lower levels as we get more and more bullish. But the problem is we just jumped right back up to extremes. So there's a lot of demand for these options. And we didn't look at this chart here when we looked at the intraday range for a market that is as bullish as it is. So that kind of stands out, maybe in a little warning type of way. All right, now let's take a look at what is driving the price action here today. So let's pull off into November and just into today or yesterday. Here, let's go. Yesterday. There we go. So very quiet day. You can see, nothing gained more than 1%. Nothing dropped more than 1%. Early on, you can see that the Nasdaq 100 was down almost 1.5% at its lows. The dollar ended up down another significant day. Remember, that's kind of one of our big drivers right now in the market is that US dollar. It was so parabolic to the upside that we had a pretty significant down day. Let me look at that. It didn't quite end up breaking the 17-day moving average, pretty much sitting right on it, but that MACD broke below its moving average in a pretty big way. Stochastics is down out of the reversal zone. So one of your bigger drops in the dollar that we've seen here for a while, and when you look at like its market forecast chart here, the dollar index, you can see we have light pink shading. Pretty, it's a bearish short-term sentiment. So this should be, well, it's kind of, it's not the perfect intermediate confirmation signal because the intermediate line did drop below the 80th percentile, but it's pretty close. The market, at least we're still above market sentiment. It's rising, and it's not too bearish of a short-term sentiment yet. But that long upper shadow, the down day, the last couple of days, this is what it looks like on the intraday chart. When you look at it here, it looks like something's afoot. Now, typically when the dollar drops, it's actually a really good sign. You can see we end up holding. We rallied up to last week's low, but we end up dropping below last week's low after having been kind of in the middle of a big range this week, and then yesterday, dropping below that. Usually it's a good thing for the dollar to drop because the market, there's typically a negative correlation, but right now the correlation is actually slightly positive with the market. So we'll see kind of what that ends up entailing. If you look at like, one of the other, if you look here back to this chart, bonds are actually up again today, which means that bond yields are falling again, right? That's remember your three-headed monster is the dollar, bond yields, and commodities. Look at the jump that TLT has had. In fact, your MACD is crossed over 0. The 8 and 17 are close to crossing over the 30. Like, we are hitting the 200-day and the 50-day. They're both sitting right there. We are hitting the point of control. So there is some pretty significant resistance here for TLT. And when you look at the 10-year yield, look at that drop there. So we got the bull tag, and we kind of rebounded on Tuesday. Pretty significant drop yesterday. The intermediate line crossing below market sentiment. Short-term sentiment, relatively bearish. It's not too bad, but it's relatively bearish there. And you can see we are more than 1%, about 1.33% below the moving average. So, we're not dark pink shading in a red line yet, but, we're also not bouncing off that bull tag either. And you remember, we're hitting a ceiling on the yields because of we're hitting the yield because of the Fed funds rate is it's not higher than this 4.5%. So that's about as high as a 10-year yield could get. But we have hit that 4.5% and come back down off of it, right? So now we're down to 4.25%. That's a pretty steep drop, relatively speaking, in the last little bit. Here's your 3-month yield, also dropping from where it was at 4.55. Now it's at 4.5. Remember, the next cut's due in December, and is expected to be a cut. The Fed is expected to cut rates, and you can see the odds are increasing. Now up, we were kind of a little bit more than a coin flip. It's now up to 2/3, 66% odds of a cut, but the odds of the next cut coming in January are down to 15. So it's up a little bit from where it's been, but still pretty low levels from where we were a month ago and a little bit before that, when it was practically a 100% chance, right, that we were going to get another cut here. And then now you can see like the gray line, the red line's gone to 0, the gray line's gone to 0, and here's the green line. The green line is that next cut, and you can see like it was at 100%. Like we had a 100% chance of getting a cut in January. So now we are at a 15% chance, and it still remains low. So the Fed's most likely going to cut in December and then stop. And that's actually, in my opinion, while it might be a bad sign for maybe the end of this year, since it's already been a great year, but it's a relatively negative sign of sign of volatility, which is maybe reason why the skew is so high. The VVIX is relatively high too, because there's still some anticipation that these cuts, there's a lot of cuts here. Remember the cuts here for this was 100% chance, or at least 90% chance of a cut, going all the way back to September, what would that be, 24th. We were there at about a 90% chance of a cut. Going all the way back to the 16th, we had a 95% chance of a cut. And then, like I said, about a 95% chance again there of getting all the way down by June to 3.25. So now it's a 0.9% chance that we'll get down there. It's only a 8% chance, almost 9, that we'd get, the 3.5, 3.75. It's only a 1 in 3 chance that we'd actually get the 3.754. That is, here's the December cut, and we'd have 2 more cuts. So there's a 33% chance of getting 2 more cuts this year by June. And then you can see there's only a 60 some odd % chance that we would actually get, again, 1 more cut anytime the first half of the year. So it's not a high percentage. And like I said, it was easily at 100% for a good chunk of time. So things are changing. And again, that doesn't bode well for the next little bit. Increases the odds that at some point in time we get this zigzag, we get a red tag here, which again, you only need a 5% drop to get a red tag, so it's not that big of a deal. And you can see every time you get a red tag, you get a green tag with a much bigger number coming after it, unless you are in a correction, right? So, and then, again, that's, we generally get right around that first pullback, the first red tag after of the correction usually ends up being a little bit bigger number than 5, about right around 10. Here's 12% with COVID, and close to 10% there, and close to 10% here. So it's going to be around 10% when you get that first red tag. But most likely it's around 5% when it's just a typical pullback, and that's kind of what I expect sometime into this year, beginning of next year, despite the volatility, the seasonality, which is very bullish for the year. But then all these cuts coming off the table actually bodes very well for the first half of the year. Like, we should be pretty bullish going into June. I do think the cuts, though, will restart here later in the year and we have issues with maybe a rising unemployment or slowing economy. But for the first half of the year, we should have a really good market because the cuts are coming off the table. Remember, the market doesn't want rate cuts for an extended period of time. 1 or 2 here or there, great, but not for to kind of prolong, but not an extended cut cycle, because that is a reset, and the stock markets typically reset a lot more uncomfortably than what anybody really wants. At least a correction, if not more often than not bear markets, when you get those extended cut cycles, like even the Fed themselves was pricing in at their last meeting. So at their next meeting that we're going to get here in a couple of weeks, it's going to be really important to see where the Fed thinks the rate cuts are going to be in 2025. Because the Fed themselves was pricing in, anticipating recession this year. They didn't say that, but they said it with their projections, because they've never cut rates this much in a relatively small period of time without there being a recession or bear market. So they were pretty much saying that they were expecting a recession, and ideally that these will change and move back up at the December meeting, which will be in anticipation of no longer anticipating a recession. And markets love that, right? The stock markets would love that. Let's take a look. With the move higher, you can see that the breadth remains relatively strong. We're obviously above 0. I've been above 35 now for multiple days in a row. 3 days in a row we've been above 35 every day this week, despite the decline. We're almost back above 100. So kind of a last hurrah type of breadth, kind of like we saw over here, right, where we had a last hurrah type of breadth at the end of that intermediate rally. That appears to be what we're getting right now, a little bit of a last hurrah type of breadth, where it's a big jump. We've had a big jump in, we had an extreme jump in the number of new highs. Right, we jumped up above 450, above 400, but we got above 450 again. We had an extreme jump in the number of stocks. Maybe the number of new highs and new low, the net new highs and new lows. We had an extreme jump again this week. The number of stocks above the 50-day moving average jumped up to 350, so back above 300. The number of stocks above the 200 jumped up above 350, or jumped above 350, but it got above 375 as well, well above the moving average. So we had a pretty good jump in breadth. You can see the breadth thrust jumped up. There's a number of advancers relative to total issues, well above 50%. Earlier this week, we got up to 60% on Monday. So very strong move to the upside, obviously closing below that. This is the bullish percent index, is a number of stocks that are showing bullish patterns on their point and figure charts. We're back up to almost 70%, another good sign for the more from a breadth standpoint. So as of right now, good breadth. The question will be whether or not that breadth remains, gives us something to work with, right? Money flow, you can see, is already rolling over. You can see that, when you have these intermediate runs, here, let me zoom out to a few years. When you have these intermediate runs, you typically get some good money flow surges here, and then the last surge is not so strong, right? Here's another strong, but the last one's not so strong. Big surges, last one's not so strong. Big surges, as of right now, the last one's not so strong. So even this is kind of suggesting. But what's interesting here, what I pointed out in my class today too, was that we are now almost back up to the peak. In fact, if you go back to the all-time high, which we are already easily above on the index, if you go back to that level, we are now back up to the same money flow level now as we were then. So we have finally recovered. It took so long because it went so low. Even when we started to rally by the financial crisis is when we finally hit our low point. It took so long to rebound that we have now rebounded enough. And that's very atypical. It's not usually any kind of pullback or correction. You usually rebound in volume as much as you do in price. That has not been the case for this correction that we had. It was a very deep correction, a very relatively deep correction. It was a very long correction in time. What it was deep because we were so far above the 200-week moving average, had a big distance to go to get down to it. So that's why it was deep. It didn't break the 200-week moving average by a significant margin like COVID. So it wasn't that kind of a deep correction, but it was a big move lower because we were so high and it was such an extended period of time. And then again, the bounce off of it was so weak initially until we finally started to get some volume here lately. And now finally, like I said, even though we're not up, the actual peak on money flow occurred at the end of 2021. Before we got that last high point, it was kind of a little bit of a divergence there. So we'll kind of keep our eyes on the money flow going in. Let's take a look at the sector comparison. And you'll notice here on the sector comparison chart, here let's just go to today. Let's go 27th. You can see, let's go to the 5-minute chart. Your big dogs are losing, and this is not a good sign. We've been talking about this the first couple of days of the week. This is not good. Like XLY, XLC moving in the wrong direction. XLU, XLP, XLRE moving in the wrong direction, right? This is a clear shift to safety right now on these sectors. You can see here. Now, we didn't close at the lows, thank goodness, but still, we broke the 17-day. If you look at the ratio chart, we are already below the 200-day, and we're just continuing to exacerbate this bearish move that we have on technology relative to the rest of the market. Remember, the three biggest companies in the S&P, the three companies that themselves make up over 20% of the S&P by themselves, are in this one sector. So this is the most important sector in the market because of that. It is the most important sector. Those three companies by themselves pretty much equate to multiple S&P sectors combined. So again, this is by far the leadership in the market. If the market might go up a day or two or a week or two without it, but not for an extended period of time without it. If the markets are going to be bullish in the first half of next year, this needs to lead the way higher. Technology and considering again, like there's been other times where it hasn't, the reopening trade I showed you 2016, but the weightings of those three companies and this sector in particular wasn't even close to the same weightings then as it is now. It's a much more important sector of the market now. It was important then, but it's way more now because the weightings have pretty much doubled since 2016, more than doubled, actually tripled since 2016, but almost triple, like 2.5 times. The weightings have increased by that much. And then the CAPE ratio right now is higher now. It's higher now, like going into inauguration. As of right now, things can change, right? And it's nearly 2 months away from the inauguration. But going into right now, or at least going into January 1st of the inauguration month, this would be the highest valuation for a stock market that any president has ever inherited, eclipsing the previous record by George W. Bush in 2000, in January of 2001. We are just above that level. And again, that period, that started a 10-year period of 2 bear markets and 10-year returns in the negative. And so it's not looking good, again, for the current administration. And it wouldn't have looked good for any other administration that would have won that election, because, again, that's a foreboding sign for any president to inherit such a strong market, not necessarily strong, but such an overvalued market. The next 4 years, like we were in a bear market 4 years later by the time President Bush won his re-election, and then we obviously had another bear market at the end of the second term. And how that plays out, on the current administration and who might win the next one remains to be seen. But it's not looking good for 8 years from now. When we are 2 election cycles away because of how overvalued and how we're going here, right? So if I were to go all the way back, as far back as I can, I don't think I can go back too far into the 90s, but let's see what we can get. So there's 2000. So here, let's go into 2001. Let's go into the December, the end of the year in 2001. So again, the election is here in November of 2000, right? Early November. You can see the XLK was already underperforming the market. Now, the stock market peaked in September of 2000. So we had already started to underperform and the stock market had peaked. But by the time we got to January, like this is kind of setting ourselves, it's not as bad, but we're setting ourselves up in a very similar way now as we did then, when we had XLK just absolutely destroying the market for multiple years. Again, the technology sector, XLK didn't exist, but the technology sector itself destroying the market for years, since that mid-cycle adjustment of 95, 96, that led to, the soft landing that gave us multiple years more of bullishness, that ultimately there peaked in 2000. So we've seen this before, and you can see we were at 12. This is how high we were on the long-term PPO, right around 14. Well, if I were to go back now and look at the current cycle, you can see we didn't quite get up to 14, but relatively speaking, we've been at pretty high levels here, and now we are starting a decline. So not the pattern. Going into Thanksgiving, it's not the pattern to be grateful for, right? It's not the pattern we want to see going into the holidays. So hopefully this is not a recurring pattern that we see, over the next week or so. All right, that brings us to our trade idea of the day, and it's actually in one of those sectors that's moving into a kind of a quasi-discretionary consumer staples type company, Dollar Tree. You can see finally, after being bearish all year long, it's been in this strong bearish. Look at all those clusters, and the intermediate line never even getting above 50 since March. Since that earnings result in March, it's just been bad, and finally kind of washing out on this earnings result in September. Basing here, retesting those lows in multiple clusters recently, and then bouncing, going into an earnings report, bouncing with finally dark green shading and a green line, a bear tag that did not turn into a bounce trade, but actually, as of right now, is turning into a reversal trade. Intermediate line finally above 50, actually in the bullish territory, almost an upper reversal zone, and the stock 8% above its moving average, which is in the 90th percentile. So a pretty good opportunity. Let me give you some context on what it looks like here a little bit longer term. Like this is, you can see how deep, this goes all the way to COVID lows, this earnings result. So pretty oversold, relatively speaking. Most of its declines are down to these lows have come in the past year, these 5-year lows. So pretty significant move. You can see, obviously we've been in a death cross environment for a very long time, to the point where the PPO is down to pretty strong levels itself, right? Down to its lowest levels of the past 20 years, going back to the bear market lows in terms of the depths of that decline, though we are still obviously way higher in price. But still pretty significant low that is turning higher. You can see the size of the candle is a pretty decently sized candle that we haven't had this whole entire time. Obviously you have 3 green arrows here lately on the stock, just recently getting three green arrows, and you can see the volume there. A couple days ago when we had the breakout was kind of almost at average volume, and then if you take a look here at the 2-line version of that 3 green arrow chart, so here you can see we are breaking up above the 50-day moving average. The 8 and 17 are crossing the 30. We're above the point of control. There's a big gap in volume above us to that 200-day moving average. So there's an opportunity for this to make a run, a little bit of a run up to the upside. Looking at all these other oscillators, you can see breakout patterns on all of them, above 30 on the positive indicator, below 20 on the negative. So finally you have the ADX rising green shading at above 20. You look at RSI and the CCI, they're finally up to strong levels too, getting above 60 for the first time in a long time, getting above 100, at least getting above 150 for the first time in a long time. The Ichimoku cloud, we are not above the cloud, but at least we are into the cloud. That's the first time we've been in the cloud for a while, and we have a weak trend developing, weak bullish trend after just having a very mature bearish trend there. And then finally looking at the Bollinger Bands and the Keltner channels, we are not above the upper band, but we are pushing up against it, and we're pushing up against that upper Keltner channel. The bands themselves look like they're close to getting some bullish momentum with green dots, which again we haven't had since early this year. So an opportunity for a new intermediate run on Dollar Tree. So I decided to come over here to the December options, coming down to that, we're right around the mid-20 delta at the time. Selling that strike, buying 1 strike away to protect. So giving us about almost a 4-to-1 reward to risk ratio, about 3.5 to 1 reward to risk ratio there. Not a whole lot of flexibility. So if this doesn't work out quick, we'll probably just take a small loss on it and move on. But we'll see. Like, we have a little bit of flexibility there. As soon as that maximum gain comes out of that window, especially with the earnings coming up, then we don't want to be in this anymore. And that's our trade idea for today. All right, and that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Also, we have our premium subscription at its biggest discount right now for Black Friday. And also follow and like us on Twitter and Facebook as well. Have a great Thanksgiving weekend, everybody. We'll see you all in class on Monday.